Picture this. You spent 5 years going on CNBC, Bloomberg, podcasts, conferences, telling anyone who will listen that Bitcoin is digital gold. That selling it is basically financial self-harm. That the correct strategy is to buy more, always, forever. You put your company's entire balance sheet into it. You borrow billions to buy more. You become so associated with Bitcoin that people tattoo your face on their arms. I wish I was joking. And then, one completely normal Tuesday morning in May, you sell a little. The reaction: Bitcoin drops below $71,500 in hours. Your company's stock falls 4.72% the same day. Over $90 million in futures positions get wiped out. Crypto Twitter collectively loses its mind. How much did you sell? 32 coins out of 843,000. That is 0.0038% of your stock. To give you a visual, if your holdings were a swimming pool, you removed roughly 1 cup of water. And the internet acted like you drained the whole thing. But here's the twist nobody talked about. A week later, they turned around and bought 1,550 Bitcoin in 6 days. So, what actually happened here? Let's figure it out. To understand the reaction, you need to understand the man behind it. Michael Saylor ran MicroStrategy, a business intelligence software company. Founded in 1989, publicly traded, respectable but not exciting. Revenue had been declining for 7 straight years by 2020. Not failing, just fading. Then COVID hit. Governments started printing money at historic rates. The US alone created over $3 trillion in 2020, and Saylor, sitting on $500 million in company cash, had thought, "This money is evaporating, inflation is eating it, I need to do something." Most CEOs would have bought treasury bonds, maybe some real estate. Saylor bought Bitcoin. In August 2020, $250 million at $11,111 per coin. The board approved it. Shareholders were confused. Financial media called him reckless. 6 weeks later, he bought another $175 million worth. And he didn't stop there. Not even close. He started issuing convertible bonds, basically borrowing money to buy more Bitcoin. He sold company stock to buy more Bitcoin. He renamed the whole company to Strategy, because at that point, MicroStrategy, an actual software business, was almost a footnote. The company had become a Bitcoin holding vehicle with a PowerPoint division on the side. By May 2026, Strategy held this much Bitcoin, purchased at an average cost of $75,699 per coin. Total investment at cost around $63.77 billion. And through all of it, Saylor repeated the same message: Bitcoin is the exit. You don't sell the exit. He became crypto's unofficial prophet. Every Monday morning, Strategy would file a new 8K showing they bought more. Crypto Twitter would celebrate. Prices would pop. It was a ritual, a weekly confirmation that the big money still believed, which is exactly why what happened next broke so many people's brains. Okay, let's look at the actual filing, because facts matter here. Between May 26 and May 31st, 2026, Strategy sold 32 Bitcoin at an average price of $77,135 per coin. Total proceeds $2.5 million. The company held so much Bitcoin at the time. The sale represented 0.0038% of their total holdings. And here's another way to think about it. If their Bitcoin stack were a 100-page book, they sold approximately 1 letter on a page 4. And what the proceeds went entirely to fund dividend payments on their preferred stock instruments called STRC, also known as Stretch. This is financial product strategy created that pays regular dividends to investors. Dividend payments are contractual obligations, not optional. So the company needed $2.5 million in cash, and they got it by selling a tiny amount of Bitcoin. Now here's the detail that made everything messier. The sale happened May 26 through May 31st, but the CEC filing that disclosed it publicly didn't drop until June 1st. And that one-day gap created absolute chaos on Polymarket. For those unfamiliar, Polymarket is a prediction market where people bet real money on events. Someone had created a contract asking, did Strategy sell any Bitcoin by May 31st? Total bets placed on this question, $79 million. Yes voters said, the sale happened May 26 through 31st, inside the window. It counts. No voters said, the filing came June 1st. Nobody could verify it before the deadline. This is not a joke. People were arguing legal contract theory over whether 32 Bitcoin sale by a $1 trillion company counted, while wagering tens of millions of dollars on the outcome. Crypto is something else, man. So the filing drops June 1st, Monday morning. Here's what happened in the next 24 hours. Bitcoin fell from around $77,000 to below $71.5 thousand. That's roughly 7% in one day. Strategy stock MSTR dropped 4.72% or about $7.52 per share to $151.57. More than $90 million in Bitcoin futures positions were liquidated in hours. But the sale announcement accelerated the slide, not because of the amount, because what it represented. Saylor wasn't just a buyer, he was the market's security blanket. Every week, Strategy announced a purchase, and the market exhaled. The big guy still believes, we are fine. When the announcement said Strategy had sold, traders didn't read the size, they read the headline. Strategy sells Bitcoin, and they panicked. This is what analysts call a sell the headline reaction. Fast, emotional, largely disconnected from the actual numbers. By the time most people realized it was 32 coins, the damage was done. One cup of water removed from the pool, and half the swimmers panicked and jumped out. On June 10th, Strategy CEO Phong Le went on CNBC's Power Lunch. He gave 3 reasons for the sale. Let's go through each one. Reason 1. Inoculation. His exact word. The idea, if you never sold Bitcoin, the first time you do, the market treats it like a crisis because it has no reference point. So you do a small, planned, publicly disclosed sale to teach the market. We are a company. Companies manage treasuries. This is normal. Think of it like a fire drill. You pull the alarm so everyone knows what to do. When there is a real fire, instead of panicking the first time they hear it. Except in this case, the market still panicked, so the drill didn't go great. Reason 2. Process testing. When you hold $60 billion in a single digital asset, you need to know your sale process works end-to-end. Custody, compliance, execution, tax reporting, CEC disclosure. Selling 32 coins at $2.5 million is a test run. Better to discover a problem at that scale than when you actually need to move something significant. Reason 3. Tax optimization. Strategy bought Bitcoin across many different time periods and price points. Some lots were acquired at prices higher than the May 2026 market price, selling those specific lots at a realized loss and replacing them. Creates a tax offset while maintaining the same net Bitcoin exposure. It's called tax lot optimization. Completely standard corporate treasury practice. The kind of thing your accountant does with stocks, except nobody writes news articles about that. All 3 reasons are legit. All 3 are normal corporate behavior. None of them mean we are done with Bitcoin, and then Strategy proved it immediately. Here's the part that almost every media headline missed. Between June 1st and June 7th, the same week the sale became public, Strategy bought 1,550 Bitcoin at an average price of $65,332 per coin. Total spent roughly $101 million. Let that sink in. They sold 32 Bitcoin for $2.5 million, then bought 1,550 Bitcoin for $101 million in the same week. The ratio: for every 1 Bitcoin they sold, they bought back 48. This is not a company exiting Bitcoin. This is a company running a treasury operation, selling a negligible amount to meet a dividend obligation, then resuming accumulation at lower prices. Saylor himself addressed it publicly at the BTC Prague conference. He called the narrative around the sale overblown and pointed out that Strategy's total holdings had actually increased after the transaction cycle. The media ran Strategy sells Bitcoin for a week. The actual story was Strategy sold 32, then bought 1,550. One of those headlines get clicks. The other one is accurate. Okay, here's the part I actually want you to take away from this. The sale itself doesn't matter, but the reaction does. Think about what happened. One company sold a fraction of a percent of their holdings to pay dividend, and the entire crypto market moved by billions of dollars. 90 million in liquidations, 1.8 billion in forced sellings, price down at 7% in a day. This doesn't happen in mature financial markets. Gold doesn't fall 7% because one mining company sold a small lot. The S&P 500 doesn't drop because Apple paid its quarterly dividend. What this tells you is that crypto in 2026 is still largely a sentiment market, one where narrative moves price more than fundamentals. One where a single institutional actor, Michael Saylor, functions as a psychological anchor for the entire asset class. That's both impressive and fragile. Impressive because it shows how much individual conviction can shape markets. Fragile because when that conviction appears to waver, even slightly, the market doesn't ask questions, it just sells. Here's what I think is the real insight. Bitcoin's price in 2026 is partially supported by the story that institutional money is all in. Saylor is the most visible symbol of that story. Any deviation from the story, no matter how small, threatens the narrative. And in crypto, threatening the narrative is the same as threatening the price. This isn't unique to crypto. Every market has narratives. But in crypto, those narratives are newer, less tested and more concentrated, which means they are more powerful when they work and more fragile when something unexpected happens. So here's what I figured out. Strategy sold 0.038% of their Bitcoin to pay a dividend. The market lost over $1 billion in value in hours. $79 million were bet on a Polymarket technicality, and then Strategy turned around and bought 48 times what they sold. The sale wasn't the story, but the reaction to the sale was. And the reaction told you everything about where crypto psychology is right now. Still fragile, still narrative driven, and still capable of turning a cup of water into a tidal wave. So, this is not a financial advice. I'm not a financial advisor. I'm just someone who figured this out and wanted to share it. If you learned something, subscribe. Next time, we're covering something equally wild. See you there.